All right, thanks everyone. Thanks team for including the paper. This paper is about putting dollar amount on drugs. So it's a market valuation, so private valuation, not about social valuation. It's a joint work with Federico and Leland, both at UVA, and Katya, who is at UBC Sauder. Okay. I guess I don't need to motivate the audience that we need to know the value of innovations so that we could probably think about firms, think about R&D incentives, and even evaluate some policies. In this paper, we aim to just use a very tractable and in some sense well-founded method to estimate market values for drugs. And the idea is to use information about when the firms develop drugs. It goes through a chain of events, and every time there is a milestone, that milestone gets announced, the market reacts, and then we put that reaction with a very stylized, simple model, and then we try to get some dollar amount. Okay, I'll make that clear. So in particular, we'll combine what we call the event study. So the event here is an announcement. Pfizer announces that they have successfully gotten FDA approval for COVID vaccine. That's enough. But it's not just that. They could also say, okay, we're going to start developing, building a drug. That's a discovery announcement. Okay, and then we think about what does that mean in terms of the firm. So the idea is that these announcements, when it's revealed, then the market has some idea, some model about what does it mean about the cash flow that the firm is going to get, and we're going to take that model and put this together to infer some value. That's the idea. It's really that, okay? In the process, turns out we do some interesting stuff. In particular, thinking about what we need to estimate is the probability of success, how difficult is a particular drug, how long does it take, what characteristics of the firm or the drugs it depends on. And so, these are all this information that goes into our model as inputs, but turns out it's a big deal in itself. So, there's a lot of work done on estimating and understanding success rate and failure rates. Okay, and at the end, I will talk quickly about a policy that I found quite interesting intellectually, and it's based on patent buyout, so that's kind of maybe the connection to the IP day, but applied to the drug buyout idea. So just basically, what should the government do? How should they implement the drug buyout? Turns out it's not as easy as I thought. Okay, our hope was also to collect this data and make everything public. That's what we are hoping to do, all the codes and everything, so people can just replicate things. Turns out this is a massive data, and it's a very difficult data to understand, and I'm still figuring out even after many years, and I'm looking forward to the discussion. Rena is going to tell me a lot about that. Okay. Again, I want you to remember that I'm not estimating social value, not at all, only private value. So we're going to miss out a bunch of important things about drugs and medicine. Okay. So the basic intuition is as follows. So imagine there is a drug with some NPV of future sales. So pi is something that captures discounted cash flow if it gets to the market, okay? And imagine that everything has gone well for this company and is at the situation where it has just submitted FDA application. So FDA is going to review all the clinical trials and all the information. And so the market is thinking, okay, what is the value? So pi is what you would get if you get for sure times the probability of success, right? So given all the information available, so that's going to be the expected value of the drug at the time of FDA, just before the FDA decision. Now, suppose if FDA says, okay, we accept, we approve this drug, then this uncertainty, the probability disappears, right? So you have is basically you get access to this stream of payment, which is pi. And so now the market sees this and reacts, okay? So when market reacts, it changes the valuation of the firm, the left-hand side, which is nothing but the change. If that's the only information revealed at that point in time, then it's just basically what is now after the announcement minus what was before. And as you can see on the right-hand side, the pi is the thing that I'm interested in estimating. The left-hand side, I'll talk about how to estimate the change in the firm's value. And if we could somehow estimate the probability of success, we have some numbers, okay? And so what does a reaction look like? This is the best picture I could draw, so of course I'm going to bias you. So there's an information, and it's like, FDA approves, boom, the value stock price jumps. Some of this jump is anticipated. Some of that is going along the market flow. We take all of that out, and what we will do is we'll calculate abnormal return, something that cannot be predicted based on the market and some characteristics. Okay, so that's called the abnormal return. And then if you take the abnormal return and then you multiply that by the size of the firm, market cap, you get the dollar value change in the firm's value. Okay, and as I said earlier, that's nothing but just putting those two equations together. You get this pi times 1 minus the probability of success. So it's the probability of failure. Okay, and if I can estimate this probability, I can estimate the left-hand side. I can recover the pi. And that's the entirety of the exercise. There's lots of wrinkles, and we do a lot of robustness. I'm not going to bore you with all that, okay? The data is kind of standard in this literature. Cortellis it's a big company that collects this data, makes it available to researchers and also to firms. So firms are interested in all this information. For us, what is important to know is that they have tons of data on drugs. Not all of them will be applicable for us. And for each drug that they develop, we know what kind of, broadly speaking, diseases that they're going to target. When did they start developing? And as the drug progresses, they keep track of it. Okay? We spent more than a year and a half cleaning the data, checking the data, and I'll talk about where it's good and where it's not so good. Okay? So that's the first one. That's the major milestone information that we have. So we can link firm, which is developing the drug, what kind of drug, what disease, when did it start, when did it end, and so on and so forth, okay? Now, the other information that we need is the valuation of the company. So we use the CRISP data, we match them. We're careful about the name of the firms, the mergers, and so on and so forth. And at the end, we have like around 600 firms, unique firms, and we see them over many, many drugs over time. And so you should think about, because we're also double checking everything with the FDA data, which becomes a little bit more, it's better post 2000, so we are going to mostly focus on 2000 to 2019 around the COVID time, okay? All good? All right, so just for those who are not, I'm sure everybody knows, everybody was anxious about COVID, so we all know how it works. So basic research happens, okay, so we're not gonna model, many of it is private firm. Again, that's another limitation of this approach is that because we wanna put dollar value on the firm's, change in firm's value, we need them to be publicly traded, okay? There are ways around, if you have data on startups, there are ways, but we are not gonna talk about that today. So discovery happens. So imagine discovery is like somebody saying, okay, so now we are going to start developing. That's what we call discovery. And they do some small test, and if it fails, they exit. Okay? If it's successful, then it goes into this big bucket of clinical trials. It's complicated. It's 3 stages. Turns out that the Cortellis data is not very good in terms of what happens here in the clinical trials, both in terms of when the information is revealed, because leakage is quite an important issue here because we don't want to have leakage. We don't want the market to already know things before we, in our data, are able to subscribe. And so we are a bit careful about that. And then, if there's a failure at any stage, there is an exit. Turns out exit is also pretty poorly recorded in the data. But then it goes to the FDA. That is reasonably well recorded. And then FDA makes a decision, yes or no. We see all that. Okay? Good? And so for us, for today, I think, and also for the paper, just focus on the start of the discovery and the FDA. I think we are just going to focus on the 2 tail events that are, I think we are quite confident that these dates that we have are the first time it was reported. For everything else, it turns out it's very hard to do that, okay? Okay, good. And again, in terms of the type of firms, there are some firms that are massive. There are some, most of them are not the big. So we distinguish, in some sense, for tractability, we define small firms and large firms. So just think about small firms as a mean market cap around 4.85 billion and less, and everybody else, the large firms are massive. Okay. This matters because of several things I can talk about afterwards, but I won't bore you today. So for us, for the paper, we feel confident about smaller firms. That those are the majority of the firms anyway, and I'll talk about the results. So let's put that all together just with a little bit of notation. The left-hand side is the expected CAR, the abnormal return, times the market capital of the firm. That gives you the change in the firm value. And the right-hand side is exactly what I just showed. So this is at the time of approval. So FDA makes an approval, something happens, okay? And so as I said, once you put this, you can estimate the value of the drug at approval as a function of a bunch of stuff that is all estimable. So we estimate this in 2 steps. So this market cap is just pure data. This expected CAR is we estimate using, a well-known method in finance and macro. And then we estimate the probability using computing risk model. We saw Gompert somewhere. We will do a computing risk with Gompert's. Okay? That allows us to have a tractable model of failure and success, and also allows us to keep track of how long does it take to go from a stage to next stage. Now, let's go back to discovery. So this is at the time of FDA approval. If we could pull it back at discovery, so discount it at the discovery stage, the value at discovery is basically just the approval discounted in an appropriate way, okay? There are 2 factors that matter. One is the time discounting, because a priori sitting at the discovery stage, you don't know exactly when you're going to be able to reach the market, so there is an expected discounting floating around the E, and that also depends on how long it takes, what is the probability that you reach a certain point, and the probability that you even reach that stage, okay? So turns out that once you estimate the competing risk, I'll mention that a little bit, you can estimate the 2 terms on the right-hand side. And in the first step, I've already estimated the value of the drug at approval. Now it gives us the value at discovery, okay? So that's what we do. The second thing we do is, remember I said this is only using the last end event of FDA approval, but you could also do the same thing at the discovery. So far as the discovery is a not anticipated announcement, then discovery also kind of gives you similar value. The thing to keep in mind, the difference between pi disk and v disk, sorry for this notation, is that here, when you start at the discovery, the value, the market is going to internalize the fact that I'm going to get market, but also I have to pay some cost, right? So this is already, this is the net value that's therefore because it excludes the cost of development. And so now these 2 things could be put together to infer a little bit about what is the expected or average cost of discovery stage. If we had good data on later stage trials, you could do that for any stage, but just that it's so hard for pharmaceutical to keep track of the date, so we didn't do that. Okay, so far so good. Okay, that's what I mean by last star. Okay, all right. So in terms of step 1, yeah. Not all this. Sorry, what do you mean? Like the risk. Yeah. And just I'll mention this, but like just around, if you start like around 8, at least our estimate shows around 8 out of 100 drugs get approved. That's the benchmark. But it varies by diseases and
Can I also ask one for clarification? First equation here makes sense. It's just that you can calculate by the discovery time ex post, right? But not ex ante because you don't.
Sure, absolutely.
Okay.
Absolutely. Yeah.
What is good for you, you're going to tell us later?
Because we could do that for some of them, we can infer the cost. And that's one thing. The other thing is that if you, yeah.
Thank you.
Yeah. So let's go do the first step is to estimate the CAR, right? The expected change in, the expected CAR. And so what does it mean? So if you have So we estimate this. Again, we follow the standard model in the literature, so there's really no innovation here. The interpretation is that when there is a discovery announcement, on average, the firm's value, if it's a large firm, the value increases by about $2.8 billion. And if it's small, it changes by about $98 million. Okay? If the approval, slightly bigger amount. Okay? But if it's discontinued and you get a negative news, then you lose money. Okay, so as expected. In the paper, we use discontinuation as well to double check internal consistency. But again, I will not talk about that. So what this means is that now if I take the expected CAR and multiply by market value, for every firm, every announcement, I have a number that tells me what is the change in the value of the firm. Okay? Now let's talk about the probability of success. So it's a competing risk model. What is a competing risk? Meaning that at any given time you're developing a drug, two things can happen. Either shit happen, then you drop it, or it is successful and it goes to the next one. So these two are competing. What we observe is only the time of either one of them. Right? Either you see something being discontinued, something being successful. One extra wrinkle with the Cortellis data is that, and also maybe characteristics of pharmaceutical, is that this take a long, long time, and then there is really no development reported. And that's a separate category that Cortellis puts, and it's a massive one, right? So that's another issue. And so we treat that as an additional, competing risk in this world. And so we then, to estimate this, so each of these risks will be modeled separately. And what is interesting is that we also allow it to depend on firms' characteristics. So this new I, the unobserved heterogeneity. So we allow for the fact that some firm may be more efficient than others in developing particular drugs. You can have a bunch of stuff on axis. You can have many characteristics of the disease, the firm, that may influence whether or not you are able to develop a drug quickly or it takes time and so on and so forth. Okay. So now, I said that when we do the valuation, we only use the first start and the end announcement because we need really the precise date of announcement. But when it comes to estimating this competing risk, we don't have to, we can be a little bit relaxed. So what we do is when we estimate this, we estimate for all the stages, including the clinical trials. So we don't throw them out because these are informative information. Okay. So here is the implied probability of success. All right. So for the probability of success between large firms and small firms turns out to be not that different. Okay. And as you get closer, it becomes more and more likely that you will be successful. But at the start, if you just do at the beginning, so only about 8 out of 100 drugs get approved. And this will imply correspondingly discount rates, expected discount rate at different stages, if we will. Following the literature, we took 0.95 as the discount rate, and in the paper we do, as everybody else, lots of checks that this is reasonable. Okay, what do we get? As I said, we are confident about the small firms, not so much about large firms. There's a lot of things that we don't particularly understand, but for completeness, we are showing everything here. So when the average value of a drug that gets approved is about 2.15 billion for small firms, and for large firms is 20 billion. And if you discount this back to the early stage, it's 98 million. If you use the discovery announcement, the net value is 50, and so you can check and figure out. Okay, so we also estimate the cost of discovery stage. So to do discovery, the R&D cost is about $38 million. Again, this is nothing sacrosanct about this particular discovery. If you had good data on announcements, you could apply it to any other stage, just that we don't have. We don't trust our data on that. We could apply this. We did this for 11 different therapeutic areas. As you would expect, the chance of success failures are different across them. The market is different, and so you can see this is only for the smaller firms and cardiovascular. So I'm just going to show here. What is interesting is that the net value not sure how to interpret this. The net value that we find at the discovery stage seem to be flat. Some of this, may be an artifact of how we model. We don't know. Okay. Good. Okay. So now I want to just take some time to talk about the application. So once you have these estimates, this is great. These are important by in themselves. But we explore a particular, application, and that's a drug buyout. I was, and Federico, we were inspired by the Michael Kremer's 1986 QJE paper, where he imagines a world where the government steps in after the patent is given and then buys out and puts in public domain. And we imagine, like, what would happen that for the drugs, okay? Can we use our method to implement that? And in particular, we're thinking about a world where the government, where the social value of the drug is much bigger. W is much bigger than the private value, and so that's where you would want the government to intervene, if at all. Okay, and so there are tricky questions come out because unlike patent, which is one-off, except for the patent pool, here it takes multiple stages, and so it's really non-trivial to think about when should the government intervene. Should it intervene at the initial stage and then buy out the rights, but then who develops? That's an issue that we explore in the paper. It opens a can of worms of optimal regulation. Or you could do it post-approval, which is the easiest to do because then there is no uncertainty, everything has been done, and so I'll talk a little bit about the easy one here, okay? So, but we have a problem. Typically it's called the Lucas critique because here we are trying to use the market reaction to estimate and then use the estimate to do the policy evaluation. But if the government is going to intervene, the market is going to respond not to the true value of the firm, but to the market intervention, what the government is going to pay. And so our thing disappears. So we cannot do both. And so what that means is that, but turns out that if you don't commit so you randomize in some sense and you say, okay, the government says I'm going to implement this with a very small probability, then turns out that you can still salvage. So we're imagining a world where even if you did this drug buyout, because the social welfare is really large, you don't do it all the time. You do it surprising the market, okay? And what is now you may ask, what is the use of all the estimates that you did? We show in the paper that although we don't have the value of we don't have social welfare, we could do, we could kind of use the literature on optimal market design or mechanism design, where you could use the Meyerson's optimal reserve price and you could save money. Okay, so we did that in a simple simulation, and the tau here is supposed to be how big is the welfare, social welfare relative to the private welfare. If it's the same as the private welfare, you still save 25% relative to paying the social welfare. But if it's large, you also save large. So it seems to suggest that it's not. I'm not saying that this solved all the problem, but it seems fiscally it's not so crazy thing to do. Okay, and so just to conclude, in the last 1 minute, we think we have a kind of tractable way to put dollar value on drugs. It's a big, huge, important issue. We make tons of assumptions. You're welcome to read the paper. Hope you like it.
Thank you. You may. Our next presenter is Christina Laternzer.
Which chord is what? Is it that one? And I don't need the clicker. No? Try deciding not to cooperate.
Here it is.
Oh my goodness. Thank you. Excellent. Okay. Hello, everyone. sorry.
Hello.
Well, hello. Thank you so much for inviting me to give my talk on my current working paper. My name is Christina Latanzer, and today I'm presenting a descriptive study of how the observed stock of Orange Book listed patents changes around first listed expiration for small molecule reference products. The object is deliberately narrow. The study only includes patents listed for approved small molecule products in the Orange Book, rather than the firm's full patent portfolio or biologic products. I'll begin with the central intuition, then define the timing anchor, and show how the pattern differs across approval cohorts. The central idea is that Orange Book listed patent stocks differ not only in size, but when they are positioned over the product life cycle. Most measures of pharmaceutical patenting reduce the listed patent set to a single quantity, such as the number of patents, the duration of listed protection, or the final expiration date. Those summaries do not show when the observed listed patent stock accumulates. Two small molecule reference products could have similar total listed patents, listed patent counts, but very different event time profiles. For one product, most of the observed stock may already be present relatively early on. For another, the listed patent stock may continue to rise as the product approaches its first scheduled expiration. The question is therefore not simply whether later products have more listed patents. It's whether more of the observed stock becomes concentrated in the years nearest first listed expiration, and for short, just FLE. I describe that pattern as patent stock thickening around FLE with one important qualification. My outcome is the annual stock of patents observed in the Orange Book. I do not directly observe the flow of newly filed, newly issued, or newly listed patents in this analysis. The diagram on this slide is schematic rather than empirical. It distinguishes the earlier pre-expiration period, the years near first listed expiration, and the period afterward. The paper focuses primarily on the pre-FLE period, whether the observed stock rises more sharply near FLE than it did earlier, and whether that life cycle concentration has intensified across approval cohorts. To make that question precise, I next define the product, the patent set, the timing anchor, and the estimate. The paper isolates one descriptive timing margin, how the annual stock of Orange Book listed patents is positioned around FLE. Prior research has examined patent quantity, protection duration, patent strength, product switching, settlements, authorized generics, and generic entry. The narrow question here is not simply whether later products have more patents, it's whether the life cycle positioning of the observed listed patent stocks has changed. Specifically, I ask, does the observed patent stock rise more sharply near FLE than it did earlier in the pre-FLE period? And has that timing concentration become stronger across approval cohorts? There are three design choices embedded in that question. First, the object is the annual listed patent stock for an NDA application product. It is not an NDC level analysis, a measure of newly filed or newly issued patents, a firm-wide patent portfolio, or an analysis of biologics. Second, the anchor is first listed expiration, or like I've been referring to as FLE, the earliest scheduled expiration among the product's Orange Book listed patents. I use FLE to organize the product life cycle in event time, not as realized loss of exclusivity, generic entry, or an exogenous shock, although I have been corrected. I believe now it is actually an exogenous shock, but no time to update the slide. Third, the estimate compares the annual listed patent stock during the 3 years nearest FLE with the stock during the preceding 3 years. I then test whether that contrast differs across approval cohorts and regulatory exclusivity groups. I use patent stock thickening as a descriptive label for a larger observed stock near FLE than earlier. Because the outcome is a stock rather than a flow, the analysis does not identify new patent creation, strategic intent, patent strength, or downstream effects on entry prices or welfare. The contribution is therefore to distinguish listed patent quantity from listed patent timing. Later products may not simply have more listed patents. More of the observed stock may be concentrated near FLE. To explain why the timing of this particular patent set may matter, the next slide places Orange Book listings within the Hatch-Waxman process. The institutional motivation comes from Hatch-Waxman. The scope here is small molecule reference products approved under NDAs. Patents are granted by the USPTO, not by the FDA. The FDA's role is to publish qualifying patent information submitted to Orange Book listing. Once patents are listed in the Orange Book, they become operational in the ANDA process. A generic applicant must make the required patent certifications. A paragraph 4 certification can initiate a patent challenge and may lead to litigation, settlement, delayed launch, or bargaining over entry timing. That means the timing of the observed listed patent stock can matter operationally. A denser listed patent environment near a salient expiration milestone may increase the number of certifications, legal assessments, and potential disputes a generic applicant must navigate. Listed patents therefore help define the patent certification and challenge environment that generic applicants must assess and navigate. This is why the paper is not simply a counting exercise. Two products can have similar listed patent counts but very different event time profiles. Related work has examined patent counts, duration, effective market life, strategic patenting, patent strength, paragraph 4 challenges, settlements, and generic entry. This paper isolates a narrow descriptive margin, how the observed Orange Book listed patent stock is positioned around FLE. Importantly, I'm not claiming that every Orange Book listing is anti-competitive or that the observed timing pattern proves strategic intent. The narrow claim is that because listed patents operate within the generic approval pathway, their temporal profile is economically relevant and worth measuring. The next slide defines the milestone I use to organize that timing, first listed expiration. I define FLE as the earliest scheduled expiration year among patents listed in the Orange Book for the small molecule reference product. I then index each product year relative to that milestone. I use FLE as an event time anchor, not as realized loss of exclusivity, generic entry, or the end of market protection. Because FLE is the earliest scheduled expiration, no listed patent defining the anchor is scheduled to expire from t = -5 through t = -0. The rise over those years therefore cannot be mechanically generated by scheduled patent expirations. Year 0 is interpreted more cautiously because expiration may occur during that calendar year. The primary comparison uses two equal 3-year windows. The earlier, as you can see here, the earlier pre-period includes year -5 through -3. The near FLE window includes year -2 through 0. The purpose is not to estimate the causal effect of expiration. It is to compare the observed listed patent stock near this scheduled milestone with the stock earlier in the pre-FLE period. With the anchor and event time windows defined, the next slide describes the data and compositional changes across approval cohorts. The data come from repeated Orange Book snapshots from 1985 through 2025. Yes, I did manually transcribe all the Orange Books myself. Organized into an event time panel around FLE for small molecule reference products. The full event time panel includes 3,209 NDA application products. I use product or drug as shorthand in the talk, but the empirical unit is not an NDC. It is an NDA application product observed annually. The primary 2-bin estimation sample includes 14,190 product year observations during the 6 years leading up to FLE. I group products into 4 approval period cohorts: early hatch Waxman, PDUFA, mid, and the GDUFA era cohort. These labels describe broad approval periods in institutional environments. I do not interpret them as clean policy treatment groups, and I do not claim that PDUFA or GDUFA mechanically cause brand-side patenting behavior. 2 compositional patterns are important. First, products with FDA regulatory exclusivity become more common in later approval cohorts. Second, the observed stock of Orange Book listed patents rises substantially before FLE. At T-1, so the year prior to the first expiration, the mean listed patent stock rises from 2.07 in the early hatch Waxman cohort to 5.08 in the GDUFA era cohort. These numbers are measured at T equals -1 relative to FLE, not at initial NDA approval. Patent stock at approval is a separate baseline quantity that may be worth investigating further in the future. These patterns mean that a simple comparison across cohorts could combine larger listed patent stock, changing regulatory exclusivity composition, changing product mix, and changes in which recorded NDA holders are represented. This is why the recorded NDA holder fixed effect specification are informative. They ask how much of the timing pattern remains after absorbing persistent differences across recorded NDA holders in average listing intensity. The fixed effect does not eliminate all compositional change. They do not address recorded NDA holder consolidation over time, NDA holder specific trends, therapeutic class composition, or patent stock at initial approval. They are diagnostic for whether the later cohort timing gradient is driven entirely by stable recorded NDA holder level differences in average listing intensity. So this slide establishes that both patent stock levels and sample composition change across approval cohorts. The next slide asks whether the shape of the pre-FLE trajectory changes as well. Okay, should have chosen different colors. This figure shows the annual event time profiles that motivates the 2-bin specification. I don't think you can see it very clearly because I chose colors that are hard to see from far away. But you see here, these are in blue and these are in green, designating the buckets. So the outcome is the annual stock of Orange Book listed patents for each small molecule reference product. Products may therefore already have several patents in the observed stock 5 years before listed expiration. Each panel represents one approval cohort. Within each panel, the 3 lines distinguish products by FDA regulatory exclusivity category, no regulatory exclusivity, primary regulatory exclusivity, or supplemental regulatory exclusivity. I created the primary and supplemental groupings to summarize broad types of regulatory protection without producing sparse arrow by code cells. Primary regulatory exclusivity means the product ever received an orphan drug exclusivity or a new chemical entity exclusivity. Supplemental regulatory exclusivity means it received other exclusivities but never ODE or NCE. The first caution is that the y-axis scales differ across panels. The safest comparison is therefore the shape of the trajectory within each panel, rather than the absolute height of one panel relative to another. The key visual result is the slope within the pre-FLE period. Later cohorts do not merely sit at a higher patent stock level. Their listed patent stocks rise more sharply as FLE approaches. That distinction is important. A level difference would mean that later products simply have more listed patents throughout the life cycle. What I am testing is a shape difference, whether more of the observed stock is accumulated in the years closest to FLE. The broad pre-FLE rise is visible across all 3 regulatory exclusivity groups, although its magnitude differs across the groups in the cohorts. The shaded regions show the contrast used in the primary regression. The earlier pre-period includes year -5 through 3. The near FLE period includes year -2 through 0. The model does not assume a sharp discontinuity at FLE. It provides a compact summary of the gradual pre-expiration accumulation visible in these annual profiles and formally tests whether that near FLE contrast differs across cohorts and exclusivity groups. The post-FLE years provide descriptive context but they are not the primary behavioral evidence. After FLE, patent stocks can change because of expiration, delisting, administrative updating, litigation outcomes, product discontinuity, or additional listings. The evidentiary focus is therefore the pre-FLE run-up, and specifically whether the stock becomes more concentrated. So the next slide translates that visual pattern into one compact estimating contrast. Did I go backwards? No, I'm bored. So the outcome again is the annual number of Orange Book listed patents for each small molecule NDA reference product. The estimation sample includes product years from 5 years before FLE through the FLE milestone year. I divide those 6 years into 2 equal windows. The pre-period includes years -5 through 3, and again, it is the reference window, and the near FLE period is from -2 to 0. The coefficient on the near FLE indicator therefore compares the expected annual listed patent stock in the 3 years closest to FLE relative to the preceding 3 years. Because the outcome is count, I estimate Poisson models and report exponentiated coefficients as incidence rate ratios. I then interact the near FLE indicator with the approval period cohorts and FDA regulatory exclusivity categories. Those interactions test whether the magnitude of pre-FLE stock contrast differs across institutional periods and exclusivity groups. Finally, I add recorded NDA holder fixed effects. So the estimate remains descriptive. Whether the annual listed patent stock is higher near FLE than before, and whether that timing contrast differs across cohorts after accounting for stable recorded NDA holder differences. So with the specification in place, let's review the results. Okay. The first result shows what happens to the baseline near FLE contrast when recorded NDA holder fixed effects are added. The estimates refer specifically to the reference cell, early Hatch-Waxman products without FDA regulatory exclusivity. In the fully interacted model, the near FLE incident race ratio is 1.184, indicating an estimated 18% higher listed patent stock near FLE than in the earlier pre-period. After absorbing stable differences across recorded NDA holders, the estimate falls to 1.151 and is no longer statistically significant. The important point is that the holder fixed effects eliminate the timing pattern everywhere. They do not eliminate the timing pattern everywhere. This is only the reference cell estimate. I did not show you the rest because it's a very big table. Instead, the attenuation shows that stable differences in listing intensity across NDA holders accounts for part of the baseline contrast. The more substantive question is whether the stronger near FLE accumulation observed in later cohorts remains after accounting for those holder differences. The later cohort does not merely have a larger listed patent stock. Its stock increases more sharply as first listed expiration approaches relative to the earlier pre-FLE stock for the approval cohort. The estimates shown here are interaction incidence race ratios. They compare the near FLE versus earlier pre-period contrast in the GDUFA era cohort with the corresponding contrast in the early Hatch-Waxman reference cohort. In the era by near FLE model, the interaction IRR is 1.423. The estimate remains unchanged at 1.49 when I add the full interaction structure for FDA regulatory exclusivity categories. After adding recorded NDA holder fixed effects, the interaction attenuates to 1.240, but remains statistically distinguishable from 1. In other words, after absorbing stable differences across recorded NDA holders in their average listing intensity, the near FLE versus earlier contrast remains approximately 24% larger for GDUFA era products than for early Hatch-Waxman products. This is the distinction between listed patent stock level and the life cycle positioning. Later products do not simply have more listed patents throughout the event window. More of the observed stock accumulation is concentrated in the years immediately preceding the first scheduled expiration. The attenuation from approximately 1.41 to 1.24 indicates that differences in which NDA holders appear across cohorts explain part of the pattern, but not all of it. This remains descriptive. Again, I want to just keep saying that. So if this were simply a uniform accumulation and collapse cycle, we would expect consistent contraction after FLE. The next slide shows that the post-FLE trajectories are considerably more heterogeneous. The cliff analysis is secondary, but it helps clarify what the pre-FLE accumulation does and does not imply. Cliff size is defined as the listed patent stock at t equals -1 minus the stock at t equals +3. So this is after expiration. A positive value indicates net contraction after FLE. If the descriptive pattern were uniform, pre-FLE buildup followed by collapse would be followed by collapse. We would expect consistent post-FLE contractions. That is not what we observe. Most cells do show net contractions, but the magnitudes are mixed and not monotonic across cohorts. The clearest counterexample is the GDOFA error group with regulatory exclusivity, where the cliff is -1.17. In that group, the listed patent stock continues to expand after FLE on average. So the empirical pattern is not a uniform pile-up and collapse cycle. The pre-FLE accumulation is visible, but what happens afterwards differs across cohorts and exclusivity groups. Because the post-FLE stock can reflect expiration, delisting, et cetera, I treat these cliffs as descriptive context rather than evidence of conduct or entry effects. Now, going back to my main contribution, I promise I'm almost done. The contribution is to separate two dimensions that are often summarized together: the size of the observed Orange Book listed patent stock and its positioning over the product life cycle. This paper therefore asks not only how many patents are listed, but when the observed stock accumulates relative to first listed expiration. That distinction matters because two products can have similar patent counts or similar final expiration dates, but very different life cycle profiles. One stock may be established early, while the other accumulates as FLE approaches and subsequently. If life cycle positioning contains information beyond patent count and patent duration, conventional scalar measures may miss meaningful differences in the generic entry environment. The main stylized fact is that later approval cohorts show more concentrated pre-FLE stock accumulation, and that differential persists, although attenuates, after recorded NDA holder fixed effects. I'll close with the empirical bottom line and then hope you guys could give me some feedback. The central finding is not simply that Orange Book listed patent stocks have grown over time. That's not a very exciting result. It is that their life cycle positioning has changed. In later approval cohorts, the observed stock accumulates more sharply. In years immediately preceding the FLE, stable differences across recorded NDA holders account for part, but not all, of that later cohort differential. The contribution is therefore to distinguish listed patent stock size from life cycle positioning. Again, this remains descriptive. And the most important next questions are what drives the accumulation and whether this timing measures predicts paragraph 4 activity, generic approval, entry, or prices beyond patent count and duration. And I have some feedback questions if you're willing to give it. Otherwise, that concludes my talk.
I live in fear of this. Can I take this out? Yes. Okay. I will never be a recorded pop star. Good morning, everyone. I'm Rena Conti, and I think it works, yes? I'm Rena Conti, and I'm a professor in the Markets, Public Policy, and Law program here at Boston University. I am delighted to give comments on both of these papers, and I want to give you a little bit of context about my comments before I talk about them separately. I don't believe in written comments as discussants, and so I have comments for both papers, but I'm not going to give you, I don't have slides. So I spend a lot of time researching and thinking about the pharmaceutical industry generally, and my research is largely on the economics of the industry, both in terms of innovation, but also in terms of the value of products once they become approved. I also spend a fair amount of time in policy circles trying to help policymakers interpret the empirical literature and do good, or at least don't do harm. My comments today are really about the empirical work of both these papers, although I agree they have policy implications. Generally, I believe that neither of these papers are ready for prime time in terms of being ready to actually slot into a policy discussion. Also, as context, the pharmaceutical economics literature is extremely picky. It's like a cultural habit of mine that like I want to talk about definitions. And the reason that I need to talk about definitions here is because the pharmaceutical industry slots into regulatory terminology, and it's incredibly important to get that terminology right so that, number one, you can speak to the broader literature that is reflecting the regulatory infrastructure, and also so that policymakers ultimately can understand what you're talking about. I think the last thing I want to say about this is that the value of these products and how social surplus and private value are split are fundamental questions that to the economics literature and also to the public policy making process of these products. So you're going to hear me come back to that, those issues in my prepared remarks. So I'm going to go backwards. So I'm going to start with Christina's paper, and then I'm going to move into Gaurav's paper. So Christina's paper is very important. It aims to identify the temporal relationship between the exogenous first patented expiration or potential patented expiration of a drug and the parent estate around that first date. It's an interesting question. It's one that enters into a very large and mixed empirical law and economics and health services research literature. But it is asking a very unique question. It is also representing a very massive data effort, which kudos to you. And I hope you'll make it public one day. I'll come back to that. I have 4 suggestions. The first is, here's where the picky Italian can't help myself comment comes in. Okay, you please must clarify what you mean by drug and what you mean by firm. Drug is typically viewed as the new drug code, or NDC, which is a 9-digit or 11-digit code, which identifies an active ingredient, a formulation, and a dosage combination. I think the NDA unit that you have clarified in the presentation reflects an NDC code, but I don't know, and I would love to make sure that I understand that. This is extremely important because an active ingredient can actually encompass multiple NDC codes, and patent estates can go over many different active ingredients. And so it would be really nice to understand your effects as not a drug product question, but actually a patent estate or a product listing. That would also help disentangle the drug effect from the firm effect, because I suspect some of your firm effect results are actually encompassing the molecular active ingredient effect as opposed to the individual drug effect. Moreover, not all drugs are, actually the vast majority of drugs that are approved by the FDA are not new drugs. They're iterations on an existing product. And so you're not really controlling for quality in your current setup. But if you looked at just new chemical entities, which are a small subset of NDC codes, you would actually control for that quality issue, and you'd be asking a more general and important policy question. Secondly, and related, I don't know how to think about firm in your empirical setup. There are a lot of mergers and acquisitions, and specifically in the FDA world, a firm is actually a sponsor, the entity that is uniquely getting the approval to market the product. That entity may or may not be the firm that actually patented the product. So I want to understand a little bit more of that relationship, and I want you to be more specific about that. Third, it's hard for me to see whether you are controlling for all patents awarded pre-approval in your setup or not. The empirical literature suggests that most patents are actually awarded pre-approval, and there is a real empirical policy question about whether the patents that are awarded post-approval are excess and maybe point to firm greed. In some sense, there's a lot of suspicion around excess patenting here, but we should be careful about under which margin they're excess. An economic model that you apply to this question would be helpful to understand exactly what your hypotheses are, and would also help think about future directions. Third, on regulatory regimes, I'm not sure I follow the economic intuition behind the eras that you have articulated, because none of them are actually altering the incentives for patents per se. So instead, what I'd like to see you use is time as a running variable, or use time as a 5-year increment block, which is more standard in this literature. And then fourth, as related to time, you are stratifying your results based on the award of market exclusivities. But actually, I think there's a more interesting question here, which is whether or not market exclusivities are complements or substitutes to patents. And that might help you better articulate why you see these differences in eras, because what is actually happening in the regulatory regime is that over time, the FDA and Congress in their infinite wisdom are expanding out market exclusivities, and actually at the same time tightening potentially the patent regime. So I'd love to see you move forward on that. Okay, with that, yes. Oh, good, perfect, okay. With that, I'm going to turn over to Gaurav's paper. Okay, super interesting paper. Provides a very novel and important method for evaluating the economic value of biopharmaceutical innovation from a company's perspective. It adds to a very considerable and hotly contested literature on the value of pharmaceutical innovation that are really pioneered by the greats, Joe Damasi and Henry Grabowski. The main innovation is to assess values based on market expectations rather than realized valuations in a net present value calculation framework, as Damasi and Grabowski both did. Both approaches adjust for product valuation based on the risks of product failure pre-launch, and both approaches can be implemented across therapeutic class, which provides a lot of nice advantages, especially for comparative static purposes. I'm not going to talk about policy implications or patent pools at all because I don't think you're there yet. But instead, I have actually five major suggestions. So the first, please redefine your product as a new chemical entity, because that's going to shrink the dimension of your problem, which is significant. And it's also going to create a much more natural comparison for the other work in this field, most notably Damasi's work, which is always focused on the value of a new chemical entity. That I realize takes data work, but there are ways of getting that down. That also will solve the inherent presumption on quality that you're making, which is that not all pharmaceutical innovation has inherently the same quality. Some is fundamentally, the product valuation is fundamentally tied up with the technological change value. And if you get to a new chemical entity, that will allow you to actually speak to both. Second, I think that you need to better identify firms and consider firm size to be endogenous to product value as opposed to exogenous. This resolves a fundamental challenge to your current results, as I actually think that your small value firm product valuations are actually too low. They imply a realized value of approximately $150 million annually in revenue, which frankly, no small firm is going to get out of bed for that level of revenue. And they certainly are not going to be able to raise money on the street for that level of annualized sales. The valuations for the large firms look too high for me. They're implying an average product launch of a realized of approximately $1.5 billion annually in revenue, and that just doesn't comport with empirical evidence. The vast majority of firms of sold drugs are more in the $500 million range. They're certainly not all blockbusters or on average blockbusters. I think that you have a great opportunity to think about therapeutic class here and actually use it again, to think about it as an endogenous characteristic as opposed to an exogenous one. And that's because there are pull and push incentives that change over time and that really target specific therapeutic classes over others. This would also resolve the very odd result that oncology and rare disease have higher valuations, which doesn't reflect higher production costs nor regulatory barriers to entry. In fact, it's the opposite. It would also help resolve the information asymmetry challenge, which implies a very strong correlation between FDA approval and other possibility of information leakage. You absolutely have other information leakage here because of ASCO and rare disease meetings that are really pushing out early results and that are going to attenuate the valuation of the FDA approval date. That is also a problem because it's going to introduce non-classical measurement error to your results. I have two last comments. The first is a methods question. I teach students how to conduct net present value calculations and real options for our business students here. Net present value calculations are actually the standard in the industry, not real options. But real options, the advantage is that you can isolate managerial flexibility and uncertainty, which are clearly rife in this market. And so what I'd love to see you do is actually re-estimate using net present value and then compare the difference and see whether you can actually isolate that uncertainty variable. And then lastly, I would love for you to see a benchmarking exercise where you estimate the expected valuation relative to the realized revenue valuations. I have that data, happy to share with you. And what I find really interesting is that there's these annualized McKinsey reports where they compare the annual analyst expectations of realized revenue for drugs relative to what actually is realized, and fundamentally, analysts biff all the time, which suggests that there's like a Lake Wobegon problem here, that all these things are beautiful and not all of these things are beautiful. And so it would be extremely interesting to really understand how much there is actually a shrinkage here on the realized value that also points to policy directions, because once you see where your expectations are relative to realized, that's when you can really start talking to policymakers. With that, thank you. Great efforts. Keep going. Thank you. Maybe our speakers can come up and answer questions.
Do you guys want to respond at all to these comments, and then we'll do some Q&A?
I'm going to start singing karaoke. I'm joking, I will not. First of all, thank you for these incredibly insightful questions. Clearly, I have to redesign some of the study, which is exactly what I came here for. To clarify the drug and firm terminology, the drug is actually really straightforward. Again, many of you probably aren't aware of this, but I actually don't work in the IO field anymore. So I'm coming back to my thesis and working up my thesis into what I presented today. And in my ignorance, I defined the drug literally as application and product number, which I should probably revise. And as far as the firm goes, again, this is in the products file that accompanies the OB. I literally just look at what the parent company is. And on occasion, I did go through and like clean it up a little, because there's many different spellings of Pfizer apparently. So I did do those cleanups. And then also I am aware of mergers and acquisitions, and I tried my best to group companies together, especially smaller firms, because I did not want them to, with fixed effects, to fall out of the sample. So I did group them with their parent company if they were ever acquired by a different company, which is probably very naive, but
Also, Mad Bob's, the data, that's impossible.
yeah, thank you. For those who are interested to know, this took me like 5 years. And yes, I can make that public if you are interested. For those of you who've never looked at an Orange Book, it's actually like not set up by row. I don't know why they don't do that, but they have an application number, product number, and then a list of patents, and a list of codes that you have to figure out actually where they go with what patent. Anyway. Secondly, your suggestion of restricting to NC is actually a very good one. I hadn't considered that, mainly in part because I haven't quite figured out yet how to really group the regulatory exclusivities correctly, which is why I group the OD and NC together, because they tend to co-occur, and then subsequently through all of the other things together, which is probably, again, naive, because the gain and the pediatric exclusivity do operate slightly differently from the rest, but everything gets a pediatric exclusivity now, so what are we gonna do about that? And then controlling for all patents. So I actually wrote this paper and then subsequently wrote several more papers, during which time I actually did get a hold of the USPTO full data set, and I have not gone back to retroactively incorporate those data into this data set. So I actually do have the data, I just haven't put those two pieces together yet, which, now that you mention it, would probably be a really good idea as a control. Did I address pretty much everything? Okay. Any other questions? No. Okay, sorry.
Yeah, no.
Sorry, I'm trying to steal the show here.
I know. Thank you. Very good comments and really insightful. We did some of the stuff that you asked us, and for example, we don't have a good realized value of a drug, but we have sales data for a subset of the drug, and we did compare in the paper we do, and they're in kind of like similar ballpark for the smaller firms, but that doesn't mean we couldn't do better. Maybe you have a better data. The other thing, yeah, okay, cool. The other thing to keep in mind, I guess, for us is like the thing about the leakage, which is also why we didn't use any of the clinical trials, precisely because of the point that you made. In the earlier version, we didn't think about it, but then we went back to check date by date, and we tried to look at conferences, news release articles, and we found that in many, many cases, those dates were predated the Cortellis data, and so it was already leaked, so we didn't use any of that. And so the only thing that, again, just we are using are these two N information. We were as careful as we could about the firm definition. We kept track of the mergers and acquisition. And so for a firm, for us, is the sponsor firm for now. We also did some work on looking at the new chemical, and it just that I think maybe our data was not that good, but we didn't have enough left over to do any meaningful exercise, which is also precisely why another issue is, I think what you have in mind is that we are not following a drug over its life cycle, because that's really not, you cannot do that because there are only few drugs that ever you can follow a life cycle. Drugs jump from different indications, different so a drug being developed for particular disease may then be tested for another disease, and so that we are careful. And so all of these measures that we have is an average at the stage level, and so we really cannot compare. So there is a little bit of that. I take your point on most of the other things, and hopefully we'll work on that. But thank you so much. Yeah.
I'll start. I have a question for Gaurav, which is, I hadn't thought about this before, but like you have this difference between the big and the small firms, which is very large. Like let's, rather than accepting Rita's perfectly reasonable concerns about that, like let's stipulate that it's correct. One of my understanding of your interpretation was that like you're estimating just the value of the project or the drug.
Correct.
But for the little firms, right, there's a market for technology.
Exactly.
Right? Like, so can you take the large versus small firms, or even like characterize what kinds of complementary assets a large firm has? Like, does it have detailing capabilities and whatnot? And use that difference to measure something about the share of the surplus that the upstream technology developer is going to be able to bargain for? Because that's a neat parameter that's kind of really present in the theory literature, but not so much.
We didn't, to be honest, we didn't think about that part. And the reason why we don't like our large firm estimates is precisely we think there's something else happening, especially the technology that spillovers, across many different drugs. And so, but yeah, I like that idea.
I just follow up.
Sorry, but you do have when the firm actually picks up or acquires or in-licensing the product, so you actually have a potential running variable that you could look at.
Sure. We didn't use it, but I think, we didn't think about it.
I just wanted to add to Tim's
Sure.
point. Can you look in 10Ks and find out if these smaller firms have some kind of deal already? Or
We were working on that
Cool.
for different reasons.
Gaurav, whatever you're viewing as a small firm, the whole point is that they're very selected on.
Absolutely. Yeah.
And so it'd be really nice to understand that relationship.
Right. I agree. And I think I also take your point to a certain extent about the endogeneity of the definition of a small firm versus a large firm. It's just that we don't even know how to model these things. So as an IO economist, I want to model everything, but I'm like, it's just so hard to model because I don't understand what's happening. and that's part of my lack of knowledge. But I take your point that it's not not the right way maybe to do it. But
Others?
I was wondering if you had any negative effect on other firms that were doing trials on the same, and under what condition, like to estimate the value of the drug, you should look not only at the positive effect of the firm that get the good news, but also the negative effect of the competitors.
this is a question that I get asked a lot, and I should know the answer by now. I don't. I am sorry. I'm just like, I know this is such an obvious thing to think about because these are competing at the product market, so it would be interesting to understand, or at least say something meaningful. We should.
When you talk about the kind of the outperformance, are you taking out some industry fixed component?
Yeah. So
Some of that must be picking up the negative effects, no?
yeah, but we didn't really open the box and carefully analyze what it means, and it doesn't even make sense. But I understand. I guess one could look holding the market, let's say therapeutic fixed, and then look at bunch of firms developing competing drugs. What happens to the value of the non-announcing firms? I think that's kind of the low-hanging fruit that one could actually do, and it's quite interesting from the IO perspective as well to see, if there is something about competition. Yeah, but we haven't done it.
That's actually where I was going with the look between the NPV and
I see.
and the real options, because real options is actually going to tell you that managerial flexibility cost.
I see. Yeah.
You're holding the mic. Yes, I have each of them.
Okay, go for it.
This is related to this large versus Tugarov. It's related to this large versus small thing. I was also thinking about kind of cannibalization type of effects, right? So to what extent are your valuations kind of net of that? So suppose you're a large firm, you already have some drugs in that space. Are you picking up the incremental value over and above your own product cannibalization things?
I imagine, to answer quickly, maybe I imagine a world where, because these are happening sequentially, so imagine, we didn't model it, we didn't quantify it, but let's say Pfizer moves first and Eli Lilly comes second for the same competing drugs, then it must be that for the same news, Eli Lilly, if there's a cannibalization, may just, have a implied value change might be smaller.
Yeah.
And so one could then systematically put this across multiple different drugs and drug categories and maybe infer, let's say that we take this decrease in value and then regress on the number of, market structure, and one could get some idea. We again, I think we didn't do it. Maybe we should have done it.
Okay, so and my question for you, which is kind of related maybe to what your discussion was kind of pointing out, I wasn't sure why we might want to take out the fixed effect of quote unquote the firm, right? Because if whatever is changing is manifesting itself as the market is moving towards people who tend to do innovations closer to the FLE, that might be, so be it. I mean, I'm not sure we want to take out the fixed effect when we are at least analyzing these kind of changes over time. And I wanted to hear what you thought about that.
I mean, that's a fair point. The point was merely to kind of control for, some firms are larger, and so they might do things a little bit differently from smaller firms. So that was the attempt with the fixed effect. But the pooled results are, I think, like you said, valid in their own right.
Christina, I don't know if this is a useful question, but I'm wondering if you thought about a firm's ability to time the grant of a patent. If we see the FLE coming up, can we start pushing to get more patents granted? And is that an interesting thing to think about here?
It's very interesting. The question is, how do we get the data for that? I suppose. There you go. Yeah.
Wait, you're going to look at like the family and look to see how we split up the prosecution of patents in our family. I'm not sure. I'm not sure that there's value to this, but I'd think about that if I were you. Is that you have some control over when your patents are being granted by, do I keep pushing broad claims or do I carve out some of what I'm going to claim, make sure that patent is going to issue before the
Yes, I've thought about it. I don't have a good solution to that yet. And the thing is, part of the problem is I don't actually observe when the patent is actually approved by the FDA, because the Orange Books are only annual. So that makes it a little bit harder. I do know when the USPTO approves the patent, right? I know when the date is, when they apply, when the USPTO accepts it, but I do not know when they enter the actual Orange Book, which makes this kind of like a, well, what do we do in that case? Which is important too, right? To properly look at, I think, what you're suggesting. So problems, I think there are some workarounds that I could suggest and think about, but yeah, I have thought about it, just no good solution yet.
That's a perfect last question because it's about timing and patent prosecution, and I have one thing to say about each. As to timing, it is now 12:13. Let's try to go back on time by having lunch and coming back here at 1 o'clock. As for patent prosecution, the reason to come back here at 1 o'clock is to hear from our legal colleagues about patent prosecution and AI, though not whether AI can invent things. That's the subject of the panel to happen in 45 minutes. So see, lunch is upstairs in the fourth floor dining room.